Oh, or even YouTube.
Here we go. So now I'm just going to share the screen.
Oh, or even
To be able to share the screen. So I'm looking for that. Can anyone see the screen?
No.
Okay, thanks.
Hi, Tim. It's Diana. I'm in the office. We can't see the screen.
Hang on, we're almost there. Thanks.
This is for the 1031 exchange, right?
Yes.
Yeah. Okay, perfect. Okay, yay. Now we can see it.
Hang on, we're almost there.
This is for the 1031 exchange, right?
Yes.
Okay, perfect. Okay, yay. Now we can see it.
Okay, if everyone can mute themselves, and we have Phil Atwan here. He's going to get started. I'll give you this back.
we want to let people unmute themselves and ask a question.
Yeah, but
Yeah.
see all this.
Yeah, Phil Atwan here is going to get started.
Okay, if everyone can mute themselves, and then if you have a question, Phil will give you an opportunity to ask that. Thanks so much.
Well, good morning, everybody. I'm really happy to be with you. I'm Phil with Exchange Resources. And if you wouldn't mind muting yourself, if you're not going to ask a question, that would be great, if that would be all right. And then ultimately, you can unmute, ask the question, and go back to mute. So that would be really cool. We're going to make some adjustments here real quick. That'd be great. That would be all right. That's it's just delayed. You can unmute, ask the question, and go back to mute. So that would be really cool. We're going to make some adjustments here real quick. That'd be great.
Okay,
You tell me what's going on.
I think you're ready.
Okay, sounds like we're ready to go. Well, everyone, today, welcome to our class. I really think that this can make a real impact in your business. At least that's what a lot of the attendees who come to this ultimately can see and do. The reason why is because there is just so much real estate out there that is not primary residence. We're talking residential, condominiums, single family, 2 to 4, 5 and above. Then you have all the commercial end, whether it be office space, industrial buildings, storage facilities, gas stations, car washes. It's whatever niche that you feel really good about. Ultimately, we'll be addressing that with those types of properties that are not lived in by the owner. They're used for investment purposes. So what basically we want to talk about today is, number one, how do you basically, number one, find who these people are? And we're going to talk about that. Number two, it isn't just finding out who these people are, but ultimately we want to know, how do you create a relationship with them? And I can tell you how you can create a relationship with people that you don't know. The answer is, you got to talk about what's important to them. So you have to be able to touch their hot buttons, or their concern buttons, or their fear buttons. And the more you can get them to talk, the more they're going to tell you what they want to do and what they're looking for. And I'd like to talk with you today about what's most important to these people. So let's talk about that instead of talking about what we're going to talk about. Number one, oops. You will. Oh, it's me. Okay. It's not working. Maybe the mouse will let me find out. Oh, there it is. If I can get to it, I will. There it is. Okay. Number one is cash flow. Investors buy property so the property will work for them so they don't have to. Now think about that. Whether it's an industrial building or a commercial building or a condominium or a single family, If you have a building that has one front door, you're interested in monthly income. There's monthly income will determine what you make, obviously, but the more front doors you have, the more often you get paid in a month. So for example, so if you want a single family, you get paid once a month. If you want a duplex, you get paid every other week, right? If you have 4-unit building or 4, whether it's commercial, industrial, whatever, you get paid once a week on average in the month. If you have 30 front doors, you get paid every day. And investors understand this. And the bottom line is they're in it for the money. That's the reason why they invest in real estate. Now there's 2 aspects of investing. One is called cash flow. The other one's called rate of return. They're both different, and they both apply in different parts and times in your life. And we're going to get into that in just a couple of minutes. That's number 1. Number 2, not only do I want income, I want my cake and eat it too. I want it to be worth more over time. You know, if you're in the stock market, and I believe in a balanced portfolio, but the bottom line is when you lose in the stock market, you pretty much lose everything. In real estate, when it goes down in value, it comes, not only does it come back up like the stock market, but the bottom line is it also pays a monthly income. And stocks and bonds, mutual funds just don't do that. So the appreciation factor, watching the equity grow over time, watching the value, the property appreciate over time, is what investors are in it for, not just the income. The income is number 1. And if you think about it, at least, and I'm an investor, here's the deal. Of all the people that you know, how many of them have the number 1 regret that these people who own, that have invested in real estate have, is they wish they had bought more back then. It seems like every decade or so, it's worth more. And investors are in for that. So that's a very important factor. You want to have a conversation with somebody, you talk about income, you talk about appreciation. Number 3, and this is what I'm going to share with you today, is not blue, it's not red, it's just information. You got to have more tax deductions, because the more you make, the more the government's going to take. And that's the bottom line. Depreciation is a huge part of tax deduction. And maybe we come back another time, we'll get into more details of how depreciation works. But it basically lets you write off the value of the building in the year that you bought it in. Over 27.5 years, you get to take this tax write-off every year, 27.5 years, if it's a residential building. If it's a commercial building, you do that over 39 years. Why do investors want more tax deduction? Because the more you make, the more they take. They take not just off of what you make net, but they also take a higher percentage because you're making more money. That's why you have to reduce the amount of taxes to increase the amount of rents that you get to keep. That's very, very important to an investor. So having said that, these are the 3 items that are the most important: income, appreciation, tax write-offs. That's why I own investment real estate. And frankly, that's why I hope you will own investment real estate. But the question is, in yellow on the right side, how do I get my rentals to do better than they're already doing? And people are asking that question all the time. And this is something that can help you generate conversations with people who own investment properties. So let's take this example. On the left yellow slide, there's 2 properties on the bottom. A is in red, B is in blue. So I guess I could have done R and B, but that's the way it works. And let's say you bought these properties, these 2 properties, in the same month of the same year, same square footage, same lot size. You bought them, they're in the same city, on the same street. There's nothing different about either one of these 2 properties, except for one thing. A is either paid off or near being paid off. B is not. B has less equity. So let's look at the orange part in the middle. Number 1, remember we talked about a minute ago that cash flow and rate of return are completely different, and it depends on what time of life you're in. So let me ask you this question. Which property will generate the most amount of income for you on a monthly basis? A, the one that has more equity, or B, the one that has less equity? if you said A, you're right. Why? Because there's no debt service or very little debt service. You get to keep the majority of the income other than taxes and all expenses. Now think about this. If that is the case, you probably want to be in your 70s and 80s and 90s with A, because you need as much income as you can generate, because that's what you're going to be living on for the rest of your days here on this planet. So the bottom line is A makes sense if you're retired. But if you're not retired, does property B make more sense? In other words, I'm going to admit somebody in here, hope somebody already did that. The B has far less equity, but the rate of return is greater on B based on how much equity that's in the building. B has far less equity, but B can charge the same amount of rent as A can because they're both identical properties across the street from each other that were purchased at the same time with the same floor plan. In other words, the rate of return on B, when you consider what income the property can generate minus roughly the same amount of expenses, B is a better deal because it helps you grow faster. It gives you a better rate of return on the equity that's in the building. Number two, appreciation. We just talked about that. Which property will do better in an appreciating market, A or B? The answer is they're going to be the same because they're identical properties, same floor plan, same street, same city. Nothing's different, except B will give you a higher rate of appreciation based on the amount of equity, because you're going to have all much either paid off or unhighly leveraged on A with debt, whereas B has a lot more debt on them. But they will appreciate in the same manner because that's the way. When inflation goes up, it has nothing to do with how much mortgage you have on your property. Number three, which property will give you better tax deductions? The answer is, well, technically it would be B, because A and B are the same as far as depreciation, but B has that precious tax write-off on the I can't say it today. That's a write-off on the interest that's in the property on the loan. Now think about it. Everybody's complaining about those SALT things that were put on by Congress a few years ago, which reduced the amount of interest that you can deduct over $750,000. You can't do that. Your property taxes were frozen down in terms of federal deductions, $10,000. Guess what? That's just not true anymore as it relates to your investment properties. It is true on your principal residence, but not your rentals. So you have full write-off on B, whereas A, you do on the property taxes, but you have very little or no debt. Folks, the whole point is re-leveraging A to take equity out to have more properties that will generate additional rent, plus more properties that will go up in an appreciating market, plus additional tax write-offs. That's what investors do. They take out equity or they sell the property because they want to go to a different property, maybe in a different place, but that's what they do to re-leverage the equity that has grown over time. That's how people make money in real estate. That's how I make money in real estate. For those of you who own invested properties, that's how you have made money in real estate. So if I decide to sell the property, my big question is, what does a capital gain look like? Because when you sell property, you never pay taxes on your equity in the building. Never. Why? Because you can always refinance the property, take all the equity out, right? So the bottom line is your CPA is going to look at this formula called the sales price minus the adjusted basis to figure out what the capital gain is on the property. So how does that work? Well, if you sold the property for $1 million that you originally bought for $300,000, your CPA is going to look at your purchase price, and that's going to be called the adjusted basis. They're going to adjust the $300,000 by adding capital improvements. That doesn't mean repairs, fixing things, paint, carpet. Those are maintenance items. But when you actually put in an improvement like, raising remodeling kitchens and bathrooms, maybe expanding, maybe getting a better roof, maybe getting rid of the windows and putting in those nice double pane, energy efficient windows. That adds to your capital gain. The higher the capital gain will be, the lower your actual, the higher you put more money you put into your adjusted basis, that would raise that, the lower your capital gain will be. And that means you will pay less in taxes. What is also going to affect it is depreciation. That actually brings down your basis. And then closing costs brings up your basis because you have to hire a real estate agent, an escrow officer, a title company. You have to pay transfer taxes, recording fees. If you're doing a 1031 exchange fees. All those are fees that will be generated, which will raise your basis. So at the end of the day, the sales price minus the adjusted basis equals the capital gain. And trust me, you don't want to do this unless you are a CPA or a tax attorney or have on file with the state of California some kind of accounting license. Because your clients will hold you accountable to this. And I just hope your E&O is paid up, because the bottom line is you're going to need it. Or they may misinterpret you and misunderstand and come up with the wrong number and still sue you. So leave this to the professionals to do. The only reason why I'm showing this to you right now is because you need to know that you're not taxed on the amount of equity in the building, you're taxed on capital gain in the building. And your CPA has to figure that out. So how much could it cost in taxes to sell a piece of property, especially if it's rental? Because you want to re-leverage again the equity to create more properties. Well, they're going to charge you, number one, between 15 to 20% in long-term capital gains taxes. 15 or 20% of what? Of number three, that capital gain that your property bears. So that goes to the IRS. Number two, you have to pay the medical or the health care or Obamacare, or I don't care what you want to call it, but you have to pay that 3.8%. If you're single, over $200,000, that this thing kicks in. If you're married, filing a joint return with your spouse, then it goes to $250,000 is when that 3.8 on your gain has to kick in. Number three, you have to pay the state of California. California is going to charge you between 9.3 to 13.3 tax on the capital gain. And then lastly, if you're selling a rental property, the government has allowed you to depreciate it. That's called allowable depreciation. You know what that means in English? You could take it or not take it. It's completely up to you and your CPA. But whether you take it or not, if it's allowable and you sell the property, the government will charge you an additional 25% of all the allowable depreciation the government has given you to take, whether you took it or not. And that is a massive tax. So the bottom line is, if you took, $400,000 of depreciation, you owe the government an extra $100,000, plus the state of California, plus the Medicare healthcare tax, plus the long-term capital gains tax. That's a huge amount of money to pay to sell the property. So the question is, why would somebody want to do that? And the answer is, in 1921, back in August of 100 years ago, the government, Congress, created something called the 1031 tax. Free exchange? No, there's nothing free. It's tax deferred exchange. What is it? Well, if you look in the blue on the right side, it says it allows an investment property or an owner to sell the property and then repurchase something that's roughly equal or greater value. And it's available to the investor not to have free taxes, but to defer the tax into the acquisition of a new property. It also allows you to grow income so you could have more doors that will produce more monthly income for you. It will also allow you to grow your investment property base so you've got more properties or better properties that will appreciate in a better market. And then thirdly, it creates more tax write-offs. Or if you just want to take this property out of this neighborhood and put it into some other neighborhood, it allows you to do that, to go to better places. That was invented in August of 100 years ago. So we just celebrated our 100-year anniversary, right? I don't look like a year over, what, 65 or something. So the bottom line is that's what a 1031 tax deferred exchange does, to re-leverage the equity to go into other properties that will also be invested in real estate. What happens though if I wind up selling down the road after exchanging or not exchanging, and I've got this low basis and very high gain? What happens when I die? Well, when you die, you're gone, so you're not going to put it in your U-Haul that goes into your grave. I mean, you know, or however you're going to do this. But the bottom line is you will pay taxes if you sell before you die and not do another 1031 exchange. How far do you go back? The answer is, well, you brought your basis with you from property number 1, property number 2, property number 3, or whatever it happens to be. So what happens is you pay taxes all the way back to the first property, which would mean that would be a mammoth gain. And you would pay a lot of money in taxes. Or if you pass away, your heirs, meaning your spouse, your children, or whoever you're going to give the money to, will get something called a stepped-up basis, especially if you have a living trust. Now, I'm not necessarily telling everybody to go out and get a living trust, but it's a really good vehicle. And there's other ways of getting this stepped-up basis. Oh, by the way, what does that mean, stepped-up basis? This is what it means. It means if I don't get a stepped-up basis, my heir pays 100% of whatever the capital gain is on the property they just inherited. Or a stepped-up basis means that when I die, whatever the value is at the date that I pass, then my heirs receive the property at that new basis based on the value on the date that I pass. Does that make sense? So in other words, what the stepped-up basis thing does, it creates an incredible amount of benefit to the heirs that inherit the property through your passing. This was created back in 1954, 67 years ago, to help investors, or to help basically those families, the surviving spouse, the surviving kids, the surviving whoever you're going to give it to not put another burden of tax on them. Now, your clients should really talk to their tax professionals or estate planning attorneys to make sure that the vesting of the property, ownership on the deed, will reflect a full stepped-up basis when they pass. But it's a tremendous benefit to an investor and to their families. So, how does this all fit together? Where are we today? This is very important. This is not a blue issue. This is not a red issue. This is not a Democratic issue. This is not a Republican issue. This is a real estate issue that NAR right now, your organization, is fighting regarding this particular plan. And so are all the title insurance associations, the mortgage associations, the accommodators association, all of the escrow associations. They're fighting it out right now because of something called the American Families Plan, and how this is going to affect real estate and 1031 exchanges and investment property, depending on how Congress votes on this. This bill was generated by the White House back in April of this year. It's asking for some pretty massive changes in terms of taxation to the sale of real estate, especially investment real estate. We're talking an exponential increase of tax. Remember just a couple minutes ago, we were talking about the long-term capital gains tax is going to be between 15 and 20%. Well, if this passes in its entirety, the White House has requested that we change the capital gains tax to ordinary income tax and raise the ordinary income tax to 39.6%. That means it's going to go towards your ordinary income, jack you up into the highest category that will be at almost 40%. And then on top of this, with the state and everything else, you're going to be looking at middle 50s to low 60% tax on your real estate. Did you get that? This is a huge deal, folks. So that is a big, big deal. Now, after I finish this, I'm going to give you some other information that I think will be really helpful. Number two, the White House package also wants to eliminate the stepped up basis, which means your heir will receive your property based on whatever your basis was when you bought the property 20, 30, 40 years ago. Which means if you've been pulling equity out of the building to live off of, or some kind of reverse mortgage or whatever, the bottom line is your heir will receive it at that basis with not a lot of equity, which means they may not be able to sell the property and pay for the taxes because of the lack of equity building that was taken out over the years. This is a huge deal. Number three, eliminating or reducing the potency of the 1031 exchange. At first, the White House says, let's just get rid of it. And then after all the backlash that they got, they changed their mind. They said, okay, this is what we're going to do. We'll keep it, or we're going to reduce the amount of money you can exchange down to $500,000. Yeah, but the problem is, see, for those of us who have properties in the big cities and just on the outskirts of the big cities, in states like California, New York, and maybe Washington and other places, here's the deal. $500,000 isn't a lot to defer. You still have a massive, massive amount of tax to pay. Some of these tax people are even saying this can cause the economy to spiral into a recession for 10 years. Now, why am I telling you all this? Oh yeah, by the way, it could also really damage opportunity zones for those of you who have been sending your clients to something like this. We want you to join NAR, who's out your organization that's fighting for you. We want you to be able to also work with the lenders organization, the title companies associations, our association, by going to this website on the lower right-hand side, www.1031taxreform.com. If you have your cell phone with you, you want to just take a picture of that lower right-hand part of that website, that will lead you to another website that was sponsored by the FEA, which is us, the Federation of Exchange Accommodators. It will allow you to give a message of however you want to your local House of Representative person who's going to vote on this, because it's been sitting in Congress now since, well, for nearly 6 months. Another week, it'll be 6 months. Number two, it'll also allow your state senators to be able to know how you feel about all these items. Now, that's all the bad news. Let me give you some good news. The House Ways and Means Committee, and that's the part of the committee that makes a recommendation to all the voting members in the House of Representatives. They looked at this program and they said, we want to rewrite it because we think it's too extreme. So what they wanted to do is, instead of giving a 39.6% cap on the sale, just on the federal end of the capital gains tax, they wanted to limit it to be between 25 and 27%. You say, well, Phil, that's a huge increase over 20%. Yes, it is, but it's not 39.6%. So at least it will cap it at a much lower level to cause investors to want to sell their property. Number two, they pulled out all the language of it regarding the 1031 tax deferred exchange. In other words, they did not want the exchange to be scrutinized under this new tax program that the White House has handed down to Congress. And number three, it also took the language out for the stepped up basis to be eliminated. So the House Ways and Means Committee has actually put a decent package together, both Democrats and Republicans, to be able to vote on where we're going to take this country in terms of taxation and the ability to move your properties around without being 60% of the whole to the government. Does that make sense? So that's what that's all about. We're kind of waiting to see when Congress is going to vote on this. We don't know. We don't know how. And after it leaves the House, then it's got to go to the Senate for voting. And then ultimately what we have is what we're going to have to live with, whatever it happens to be. So that's kind of an update on what's happening with the 1031 exchange and capital gains taxes and the stepped up basis. And that's just only 3 areas of a lot of different areas, but I thought you'd like to know about that. Again, this is not Republican, this is not Democrat, this is not blue, this is not red. It's just the business that you and I are involved in to help our clients sell and buy. Because if you slow that down, everything changes. Okay, now let's say you take a listing and you're talking to your client and they're selling a rental property. The question is, do you have to put any language in your RPA to be able to do a 1031 exchange? The answer is yes. First thing you should do is go to your agent's remarks in your listing that you're taking on your computer into your CAR website that tells the buyer that the seller is doing an exchange and that the buyer is going to cooperate. The answer, cooperate with what? The answer is on top. You see where it says accommodator or qualified intermediary? You have to have a company like ours that will facilitate a 1031 exchange on behalf of your seller. The best way of doing this, and some agents write it in the RPA, and that's okay, it'll work. But the best way of doing it, right in the middle, is see where it says CAR zip form. There's a zip form for that. It's called the SES, or the seller's intent to exchange zip form. It allows your seller to say, I'm doing an exchange. I have to bring a third-party qualified intermediary / accommodator into escrow to set up this exchange on my behalf. As long as that language is in there, it's perfect. This zip form is the best way of doing it. You can still write it on your RPA. Remember, if you look in the bottom in red, this is so important. The exchange must be set up by the accommodator before escrow closes. On an average, I get between 2 and 4 calls a week of people who've already closed their sale escrow and now found out how much they're going to have to pay in taxes, which is going to cost them between $50,000 to maybe $450,000 in taxes. That's just gain, I'm talking taxes. And they get, it's like they put their finger in a socket. They're freaked, but it's too late. That language has to be in the sale. We have to set it up with the escrow officer before escrow closes. So this is just a huge area. And when you go to buy the replacement property, there's also a buyer's intent to exchange as a BES zip form. Make sure you use those forms. They're easy to use for the most part. They're CARs form. So the bottom line, it will help you with the sale and the acquisition of investment real estate. But remember, you have to talk to a company like ours who's going to facilitate this to you before escrow closes. So which properties qualify for a 1031 exchange? Which properties are actually eligible for a 1031 exchange? There's only 3. Number 1, it has to be investment real estate. So how do you define investment real estate? This is how it's defined. Number 1, it's held for income. So if you charge rent, it could be an Airbnb, it could be a condominium, single family, multiple units, any kind of industrial, commercial, whatever. As long as it's held for income, it qualifies for the 1031 exchange. Number 2, if you're not renting it out, but you're using it for your business, it qualifies for a 1031 exchange because it's business use. The government considers it as investment real estate. Number 3, vacant land. Vacant land could be held for investment. How many of you would like to have bought some vacant land in Malibu or Manhattan Beach or wherever, Long Beach? The bottom line is that an investment vacant land was held for investment. You didn't live in it, right? It wasn't your second home or vacation home, but you held it for investment. And it could be 1031 exchange. Next, if these things are qualified, then what does not qualify for a 1031 exchange? Your primary residence never qualifies for an exchange unless, let's say it's a multiple unit building. So let's say it's a duplex or fourplex, whatever. You live in one unit, you have investment, the other ones are held for rent. So you could exchange just those units. So whatever that fractionalized pro rata portion of that sale is, you can use that, you can utilize that as a 1031 exchange. So 50% of the property, 80% of the property, wherever that percentage is, that is investment versus your principal residence. Your principal residence portion is eligible, as long as you qualify for it, the 121 principal residence exclusion. That's up to $250,000 to an individual, up to $500,000 to a married couple, as long as that only applies to your primary residence portion of the sale. The remaining balance of that, which is investment, is exchangeable. Number 2 and 3 here, your second home, your vacation home, are really misunderstood by the general public. It is not a rental property. It is not an investment property. It is your vacation home or your second home. It does not qualify for a 1031 exchange. That makes sense? You can convert these things into a rental, but then you have to file at least 2 tax returns or 24 months as a rental. Very, very important. Your CPA will show this in the Schedule E of that person's tax return. What else is not eligible for an exchange outside your primary residence, your second home, your vacation home? The answer is a business opportunity. So for example, if I had a gas station, I have 2 things. I have the business of the gas station. I have the property of the gas station. Well, the property of the gas station is definitely exchangeable, but the business and the equipment of the business and the inventory of the business and the goodwill of the business is not exchangeable. They would have to pay the taxes on the business part, but on the actual property part, because it was productive use in the trade or business, it qualifies for a 1031 exchange. Lastly, flipping or developing really depends on the taxpayer's CPA who's thinking about doing the exchange. But I got to tell you, in most cases, the CPAs will say no, because flipping and developing is not holding and renting. If it's held, it's just held to fix up and then sold. That's why most CPAs will tell you no on flipping. So the question is, the government says it only could be a like-kind exchange, all right? So what does that mean, like-kind? If I'm selling an investment condo, can I buy a 40-unit apartment building? Can I buy, if I'm selling a single or a single family or a condo rental, can I exchange it into vacant commercial land? The answer to all the above is yes, because of how investment real estate is defined based on those last 2 slides we just saw. So as long as you're selling investment real estate, you can purchase any kind of investment real estate anywhere in the United States of America. We've seen a lot of people leave California with their properties, especially investors, because of the way they've been treated by the government, by some of the counties. And the bottom line is that these can be exchanged other places like Tennessee, Florida, Texas. We see them going to Nevada. We see them going to Idaho, Arizona, just to mention 5 or 6 of them. You can go anywhere in the US, Hawaii. But the bottom line is, as long as it's investment property that you're selling, you can go back into investment real estate anywhere in the USA, and it's allowable under Code Section 1031. Now, because of time and where we are today, I want to go over some of these issues. You can't do this whole thing today. We'll have to come back another time. Even though there's 5 different ways of doing an exchange, I want to talk about 2 of them today. Number 1, it's called a delayed exchange. A delayed exchange is mostly between 85 and 90% utilized in our country and in California more than any other type of exchange. The delayed exchange says, I have to close the sale first and then purchase again a replacement property. But the question is, what is the timing? And what is the government expectation to make this happen? So here's the deal, folks. Number 1, I have 180 days from the time the sale escrow closes. Doesn't matter when you open escrow. It doesn't matter when you enter into a contract. What matters is when the sale actually closes escrow. And you have, beginning that day, 180 days to close escrow on whatever you want to exchange into. Day one is not the day of closing. The day of closing initiates the timing. Day one is technically the next calendar day. So let's see, today is the 18th of October, it's Monday. So that means tomorrow, the 19th, is day one of 180 days, okay? Number two, you have the first 45 days under this delayed exchange, the first 45 of the 180 to name by address of what you're going to acquire. You can also use APN or legal description depending on where you are in the outskirts of where this property is located. 45 days to name, up to, if you look in the red, look just below it. Under the 3 property rules, you can name up to 3 different properties. You can change the list of qualified properties that you could acquire from. But you cannot change the list after day 45. It's really important that you know what you're going to buy, because this does not give you a lot of time to look after the sale closes. Now, I don't want you to get confused, because a lot of people are confused on this. When can I go into escrow on a replacement property? The answer is anytime you want. When can you start making offers? You can start making offers the day you go into escrow on a sale. It doesn't matter when you make an offer. What matters is when you close. And you have to close your new purchase within 180 days after the sale closes, with the first 45 days to name. So when you go into escrow on a replacement property, it's of no consequence. Is a consequence. It's got to be, that address has to be on that list, and it has to be at least one of those 3 properties. You can also buy 2 or 3 to diversify the cash in the mortgage. We'll talk about that in just a minute. But the bottom line is, you got to close whatever's on that list within 180 days. Now, we will go into the 200% rule for another day. That really involves going to other states where you have to buy a whole lot more than 3 properties to buy equal or greater in value. Here in the big city, it's the 3 property rule that's almost exclusively used as far as replacement properties are concerned. So I don't know if any of you have any questions, or if you want to unmute yourself and ask anything, talk about anything that we've talked about to this point before we move on to the next part. But the bottom line is, this is your chance if you'd like to ask a question. If not, that's okay, we'll keep moving. So the bottom line is, this is huge. Oh, by the way, remember that zip form I showed you just a few minutes ago, the seller's intent to exchange zip form? Did you know you can put contingency language in that zip form? You know what the contingency language allows you to put in? That you're not going to close your sale until you're in escrow on a purchase. Or you can opt to get a 15-day extension, or a 30-day extension, or a 45-day extension to your sale, so you don't start the 45 days and the 180 days to start ticking, because they don't tick until you close. It's like preventing a bomb from going off. You can control the timer, but you've got to have language that you would negotiate up front when the buyer comes in with an offer that you may need an extension. And it's contingent upon you finding another piece of property. So if you find a piece of property sooner than the 15 days, or the 30 days, or the 45 days, or the 60 days you extended escrow, you drop the contingency. Or you may qualify that by saying, not only get into escrow, but approve a prelim, or approve a physical inspection on that property. Then you can drop the contingency. But you've got to negotiate that up front. You're not going to get a buyer to negotiate that 2 weeks before escrow closes. That makes sense? It's really important. There's another kind of exchange, and this one is very popular in markets like the market that we're in. It's called a backwards or a reverse exchange. A reverse exchange says, I'm going to buy and close my purchase first through the accommodator. Like any exchange, you have to have a company like ours involved in each aspect of the purchase and of the sale. Regardless if you just do the delayed exchange that we just talked about, or this backwards or reverse exchange, when you close the purchase first. This reverse exchange helps people who either have a lot of cash or number two, some cash, but with the ability to borrow, like a swing loan, bridge loan, a line of credit, or just put enough of the down payment on an acquisition and get a lender to join on the acquisition. It allows you to close the purchase first. Now, this is just personal opinion, but I gotta tell you, most brokers are saying do the reverse in a market like this. Because if you're afraid that you can't find what you're looking for, why would you want to sell your property first? Wait till you find what you're going to buy, get into escrow on that, and set up this reverse exchange. Because you have to close your sale 180 days later. That's a lot easier to close a sale in this market than it is to close a purchase because of the availability of property, because of inventory of property. So the bottom line is it lets you wait till you find the right property. And the key to any 1031 exchange, because remember we talked about releveraging for income, appreciation, tax write-offs. Doesn't it make sense that the key to an exchange is not selling, it's what you're going to buy? You've got to be very deliberate and on purpose. You've got to go with a property that's going to be best for you. So the bottom line is this reverse exchange is the perfect fit for them. Like I said, it does require on the 2 bullet points, the upfront cash and financing. And number 2, it requires on our part, because of the federal government and the rules regarding the reverse exchange, we have to set up a holding corporation that will take title to the property you're selling the day before you close your purchase. So you're not holding both properties at the same time. We can come back and talk more about the reverse exchange in terms of the details of it. But just know this, you can close a purchase first, a sale second, up to 180 days later with this reverse exchange. And this is a big tool, very, very popular in this marketplace. Hybrid will actually allow the 2 of them to be combined. We'll talk about that another time as well. There's also something called the build-to-suit exchange, which will allow you to do construction on the new property from the proceeds of the sale. This is a kind of a lengthy one to talk about. We can come back and do an expanded or advanced class, or we can talk about hybrid, build-to-suit, and those kinds of things like that. But I want to talk about the IRS monetary replacement requirements for an exchange. This is really important. And this is misunderstood by a lot of clients out there who want to exchange. Frankly, a lot of agents get this messed up too. And that's why we're here to explain this to you today. Number 1, the government demands that all the proceeds from the sale be reinvested into the purchase of the new property, all of it. That makes sense? In other words, the client is not allowed to put money in their pocket. 2, the investor must reborrow when they go to buy at least the amount of debt that was paid off if there was mortgage that was paid off when they closed their sale. In other words, they have to reborrow debt. A lot of people say to me, well, Phil, don't I just reinvest the equity only or just the capital gain only? And the answer is no. A lot of people say also, don't I have to buy for $1 more than what I sold for? But I can put some cash by over borrowing and putting cash in my pocket. That's wrong too. Let me show you what I mean by that. And I hope this is going to help. There are selling expenses when you go to sell a piece of property. There are 2 kinds of selling expenses. There's recurring and there's non-recurring. Non-recurring are allowable sale expenses that is allowed to come out of the proceeds of the sale. What does that look like? That would be commissions, escrow, title insurance that the seller has to provide to the buyer, transfer taxes, LA County, LA City, recording fees, exchange fees, or any contractual obligation or agreement between the seller and the buyer for repair. The seller may want, the buyer may request that they get reimbursed or get a credit from the seller in cash for things that have to be done to the property or anything that he agreed upon or anything that needed to be repaired. Or the seller can just simply pay for it because the buyer requested it and it's contractual. That is called non-recurring costs to sell. These are all allowable to come out of the proceeds of the sale. Versus recurring, which is not allowable. What's that? Well, property taxes, recurring expenses to a piece of property, homeowner's insurance, fire insurance, or any kind of HOA fee. These are all recurring costs to maintain the building. Those are not allowed to be reimbursed or paid for as a closing cost in the 1031 exchange, or you pay taxes on the difference. Next, here's a good example. Let's say you sell the property for $1 million. Your one-time non-recurring closing cost is $70,000. At the close of escrow, you walk away with $930 if you have no debt on the property that's going to be paid off. So if your property is paid for clear, then you have to buy a new property for guess how much? Well, you sold for $1 million. All the cash from the sale has to go into the acquisition, and your client has to buy for a minimum of $930,000 or greater. Fine. But what happens if they have a loan or multiple loans that have to be paid off on the sale? That includes your first, your second, your HELOC, line of credit, whatever it happens to be. Let's say the cumulative payoff is $400,000 of debt. So what's left after non-recurring closing costs is $930. Then that would be paid off. That leaves you in cash $530,000. Well, that's what the accommodator has to hold for the client, whatever cash comes out, either the $930 or the $530 in this example. So what's the new minimum purchase price when you only come out with $530,000 of cash? The answer is $930,000. Why? Because of this, and this is really important. You have to replace all the $530 of cash that we're holding other than those non-recurring closing costs we just mentioned. It has to go into the acquisition. If you keep any of it or pay for recurring costs, it's considered as boot or taxable. So you still have a good exchange, but the money you keep or you utilize in a way you're not supposed to, but with reoccurring costs, that difference is taxable. The rest of your exchange is still good. Make sense? Plus, you have to reborrow the $400, because how are you going to get back to $930,000 unless you reborrow the $400,000? So remember, you're not allowed to keep cash. Even if you're going to put money into the property that you're selling, or you're going to put cash into the new purchase that you want to fix up after you acquire it. You can't overborrow to put money in your pocket. You can't use cash to pay off a loan on other properties you own. It all has to go into the acquisition of the replacement property. All the above are taxable. So what's mortgage replacement? That $400,000 we just looked at? Well, you either buy a property and get a new mortgage to make up the debt relief. So there is no debt relief from what you paid off at $400,000. You reborrow $400,000 or greater. Or if you don't or can't qualify for a mortgage, the government will allow you to go to your bank account, put in new cash as cash replacement of the debt. It's like paying down a mortgage. So if you come in with $300,000 of new cash, all you have to do is borrow $100,000. Or if you, since we paid off $400,000 of debt, you can bring in $400,000 of new cash into the new purchase escrow as debt replacement. The seller can carry back for you. You can assume the seller's existing loans or any combination of the above. As long as you have debt replacement, as long as you have cash replacement, you buy in our example for at least what, $930,000 or greater, you have a good 1031 exchange. And the government, this is how the government wants it done. Can we send earnest money into the acquisition of the new replacement property? Yeah, we can do that. As long as we're holding the funds that came out of the sale, that means you have to close the sale first. And now we give escrow the wiring instructions. We set up a client trust account for your client. If they need EMD money, we can forward it. But if they find a property and get into escrow before they close their sale, then they will have to produce their own EMT money. Does that make sense? And we'll talk to escrow to help them get reimbursed with the proceeds that come out of the sale, because that's a reimbursable amount of money that can be given to the client, the EMD, for the new purchase in this 1031 exchange. How safe is that money? Because remember I said the accommodator has to hold the funds? How safe are those funds? Now, I'm not here to push myself. I'm not here to tell you to use our company. But I am telling you this, if you're not using our company, this is what you need to hold your accommodator feet to the fire with. You need to hold them accountable to this. Number one, the exchange funds that come from the sale should always be held in a single client trust account and never a commingled account where you put other clients' exchange money in. You know, some of these accommodators, they commingle funds, they put it into one account. Did you know those are the easiest accounts, these thieves who get on there with their laptops that steal money out of escrow accounts, showing false payoffs or doing whatever they do it for exchange companies, they even do it to title companies. So the bottom line is never work with an accommodator who commingles money. Number two, make sure it's not in a corporate account of the accommodator, but a trust account, a client trust account. That is so important. Because if they go bankrupt, it's corporate money. That money goes into bankruptcy and your client loses their money. And believe me, this has happened a number of times. Number three, the exchange company should never take a verbal to move funds, ever. The client should sign an authorization for a release of funds, and the accommodator should call back the client to confirm this was really them who sent this and ask them a couple of questions like, how much was it? Where is it supposed to go? And really quickly, the accommodator will know if this is a fraud or not. Make sure they have plenty of bonding and errors and omissions insurance. And for crying out loud, make sure they have internal counsel, like attorneys on staff who specialize in exchanges, not in escrow, not in title insurance. That's my suggestion. So what's qualified? Remember, you can't exchange into a property you already own. Number two, you can't even buy from a relative if they're not doing a 1031 exchange. You can't pay off loans on other properties you own, whether it's your home or your rentals. You can exchange into a DST, but not a REIT. A REIT is a real estate investment trust. We don't really have a lot of time to talk about that today. That's you're buying stock. You're not buying property. In a DST is Delaware Statutory Trust. I think a number of you are already familiar with those Delaware Statutory Trusts. We can come back and talk more about that another time. And be careful. You cannot buy into an LLC or a partnership. The seller that sells has to be the buyer that buys. You can't buy stock or shares in an LLC or an ownership, a partnership. Government will not let you do that. You just have to be very, very careful. Now, here's a question people ask all the time. Can I move into the property I'm exchanging into because it's nicer than my home? Can I retire in that property? When can I convert it for my personal use? Here's the answer. Talk to the CPA. That is a tax rendering decision that you or our company cannot give. But let me give you a little flavor for this. Number one, the government says, no, you can't move into the property unless there's some kind of a unexpected, unforeseen, or unplanned change in one's intent and one's situation. The intent is to buy the whole. A lot of people say, okay, how much time after I hold? Well, it does say after 2 years, but not with the intent to move in, unless something changed that you could prove in an audit. So please, don't try to even answer that question, because the bottom line, you'll just get into trouble. I'm going to pass this because we're running out of time. Really quickly, I'm going to go past into this point. How do you find these investors? How do you actually put, they say faith is shown by what steps you take. So the question is, what steps are you taking to meet new people? Because the lifeblood of what you and I do is to get in front of new people who own investment property. So how do you find that? The answer is, it's right under your nose. your title company can provide you these absentee owner farm packages of people who've held these properties for 10 years or longer that are rental. You want single family, you want condos, you want 2 to 4 units, you want 5 units above, or virtually any kind of commercial or industrial type of property. They can give that to you, but only the ones that have held title to 10 years or longer. Why? Because there's equity in that property. Remember we talked about with the equity, the higher the equity, the lower the rate of return, because you can't charge more for rent because you have more equity in the building. The bottom line is the rate of return is greater on a leveraged property. So you want to talk to people who've owned their properties at least 10 years or longer. Number 2, I have a series of like 16 marketing pieces that we've created just for the real estate community to be able to start communicating on those 3 things that we talked about earlier. What's important to them? Appreciation, tax write-offs, and income. And all these questions, whether the people live here or they live out of LA, because a lot of people have left and they live in different parts of the country, whether it's Denver or wherever they have. And they've converted that property into a rental. Those are perfect people to target, to bring their properties closer to where they live without having to pay all those taxes. And maybe to get a better rate of return off the equity because some of the cap rates are better in other places. So the bottom line is we have a list of questions that the investor can ask, and we have multiple of these marketing pieces. This is just one of them. How do you know what your rate of return is? You look at your income, you subtract your expenses, that's your net. Number 3, number 4, you figure out the amount of equity in the building, very simple. What did you sell for minus all the debt against it? And then you calculate through number 5. You take the answer to number 3, you divide it by 4, that tells you what the rate of return is. Folks, the higher the equity, the lower the rate of return. And I'm telling you, these people will be shocked. They're only getting between 2%, 3%, maybe 4% on hundreds of thousands or millions of dollars of equity. But they don't know because nobody's ever shown them. And here's the deal. This was created, this formula, by a couple of CPAs and myself. This is what they do with their clients, to show them what the rate of return is. What a wonderful way to work with people by not having to sell or talk them into anything. Just talk about those 3 things that matter most of it. And this income thing is a big deal. I hope this was helpful to you today. I'm happy to come back and do some more of an advanced class where we can get into some of these other items that we just didn't have time to cover today. I want to say thank you to Manny. He's been very good to our company, and we're really honored to serve you, the agents who work with Keller Williams. It's just been a pleasure. That's my email address if you would like those marketing letters. Send me an email, philatwan@gmail.com. I have plenty of brochures and business cards, but more importantly, I can email you items that you can give to these people. And if you like the paperless thing. Don't forget to go to 1031taxreform.com in the lower left-hand side, highlighted in yellow, because we're waiting on Congress to make a move that can radically change our business. Not just the exchange business, but the real estate business. Because remember, they have to pay taxes, sell their second homes, their vacation homes, and their primary residence. Anyway, thanks for tuning in today. Have a great day. And I'm not really sure what to do with the controls at this point, or if they're going to take it over at the mothership here. But thank you for tuning in today and have a great day.
presentation. Are you the person that did the presentation of 1031 extension?
I wasn't helping.
I wasn't here.
Oh, well, you know, they record.
Did they
And it's
record
on
Caleb's
Facebook
card?
Live. So you can ask them and they will give you a link so you can go back and watch it.
I will.
What's your name?
John Evans, I'm using my
Hey,
business
John.
card.
Nice to meet you.
I
Here's a
just.
couple business cards, I'll put it right up here. Here's kind of the general on how the
Here's
exchange
my
works.
card.
You know, it's a pleasure talking with you.
Yeah, are you in a rush?
I can talk to you for a couple
One
minutes, but I
minute.
have to,
Can you
I
give me
go
one
back
minute?
to the east
One
side of the town.
Me too, I'm going over to, I have to go. But,
No, I'm going to the east side of the county, not the city.
oh, the county,
Yeah,
okay, 2 seconds. I have a friend who was gonna do a 1031 exchange. She said she had an agent to do the 1031 for the condo and a house she found in the valley. And I said, oh, okay, fine, she already has them. She's
Is it
my
rental?
best of friends.
is it a rental property or a
It's
private
a-
residence?
She wanted to purchase the property in the valley and sell her condo in West Valley. Here's what got me confused. She labeled 1031 exchange agent. And I said to her, I don't know, how many of you are, it's such a thing.